Welcome to Finance Unpacked, the channel where we break down the most innovative tools and strategies to help you achieve financial freedom. In today's rapidly evolving trading world, one technology stands out for its game-changing potential: AI-powered trading bots. Whether you're a seasoned trader or just getting started, automation is no longer a luxury, it's a necessity. In 2025, the right bot strategy can mean the difference between scattered trades and consistent portfolio growth. Bots are reshaping modern trading and how you can build your own diversified, profitable bot army without writing a single line of code. Artificial intelligence has revolutionized many industries, and finance is no exception. AI trading bots bring powerful benefits that traditional, manual trading methods simply can't match. These bots operate without emotion, monitor markets 24/7, and execute trades with unparalleled speed and accuracy. They're not just for hedge funds anymore. Thanks to advancements in no-code platforms and intelligent agents, retail traders now have access to the same level of technology that once powered Wall Street giants. Imagine having a system that runs autonomously, testing and refining strategies, reacting instantly to market changes, and giving you the freedom to focus on strategy rather than screen watching. In 2025, the trading world is shifting from reactive to proactive. Bots provide consistency and logic in a market where emotion and guesswork can lead to disaster. Even the best human traders struggle with bias, impatience, and fatigue. AI, on the other hand, sticks to the plan, follows the data, and never deviates. This consistency can create compounding returns over time and drastically reduce your exposure to risk. Automation also frees you from micromanagement. Instead of staring at charts all day, you can focus on designing strategies, analyzing performance, and scaling what works. But not all bots are created equal. The key to success lies in diversification and intelligent portfolio design. By deploying a variety of strategies across different assets and timeframes, you minimize drawdowns and improve your long-term profitability. Some bots are trend followers, others scalp on shorter timeframes, while others may look for mean reversion or arbitrage opportunities. Diversification spreads your risk and allows you to benefit from different market conditions. If one bot underperforms, others can compensate. Let's explore some popular bot strategies that are performing well in 2025. One of the most reliable styles is the trend-following bot. These bots use technical indicators like moving averages, volume breakouts, and momentum indicators to ride the direction of strong price movements. They're great in volatile, trending markets and can lock in significant gains if programmed with solid risk parameters. Then there are mean reversion bots, which buy when prices dip below expected levels and sell when they rebound. These bots work best in range-bound markets, and while they may not capture huge wins, they deliver stable, consistent profits. Scalping bots operate on short time frames like 1-minute or 5-minute charts. These bots thrive on small, frequent price movements, executing dozens of trades per day. When paired with low latency and tight spreads, scalping bots can be highly profitable. However, they require excellent execution and risk management. Another powerful bot style is the liquidity hunting bot. These bots seek out inefficiencies in less liquid markets, such as altcoins or niche forex pairs. They take advantage of sudden volume spikes, wide spreads, and slippage to gain short-term profit. While riskier, they can offer higher rewards when managed correctly. One of the most underrated yet vital components of bot trading is portfolio oversight. This is where AI becomes even more powerful, not just in executing trades, but in managing the performance of multiple bots in real time. Imagine having a metabot that monitors your entire trading system, reallocates capital to the best performers, and shuts down underperformers automatically. This is the concept behind AI-powered portfolio rebalancing. It's like having a hedge fund manager built into your system. You can now use platforms like 3 Wonder Trading, or even no-code Python frameworks to implement smart rebalancing. These platforms allow you to set conditions. For example, if a bot's drawdown exceeds 10%, pause it. If another bot's win rate improves beyond 70%, increase its capital allocation. These rules ensure your capital is always working in the most efficient way possible. In 2025, static portfolios are being replaced by intelligent systems that adapt to live market conditions. This dynamic approach reduces risk and increases the stability of your equity curve. But how do you start building your own bot army? You don't need to be a coder or a data scientist. Thanks to modern platforms and free resources, anyone can get started in under an hour. Begin by selecting a bot platform that supports your exchange, like Binance, Bybit, or Coinbase. Platforms like TradingView allow you to copy or customize strategies using built-in indicators. Many providers also offer strategy marketplaces where you can review historical performance, risk levels, and community feedback. Next, define your trading style and risk tolerance. Are you looking for fast-paced, high-frequency trading? Or do you prefer longer-term, low-risk strategies? Once you've chosen your strategy, deploy 2 to 3 bots with small capital. Track their performance using tools like Google Sheets or portfolio dashboards. Focus on metrics like win rate, drawdown, number of trades, and profit factor. Review weekly and reallocate capital to your strongest performers. Most importantly, set kill switches. If a bot hits a certain loss threshold, stop it immediately. Avoid the gambler's fallacy of thinking losses will reverse. Treat bots like employees, reward those who perform, and fire those who don't. Another game-changing tool in 2025 is the integration of ChatGPT with trading plugins. You can now ask ChatGPT to compare financial metrics, interpret earnings reports, and suggest trading signals. Combine it with real-time data feeds and plugins, and it becomes a full-service trading assistant. As you expand your bot network, consider running themed portfolios. For example, a trend bot portfolio for major forex and crypto pairs, a scalping bot portfolio for BTC and ETH, a mean reversion portfolio for range-bound markets like gold, a high-risk altcoin portfolio with tight risk control. Each portfolio serves a unique purpose. Monitor them separately, track equity curves, and rebalance weekly. Over time, this modular approach creates a resilient system that performs well in multiple conditions. Let's not forget the most common mistakes traders make when starting with bots. Using too much leverage, relying solely on backtests without live testing, ignoring stop losses or letting bots run indefinitely, copying strategies blindly without understanding them. Avoid these traps by staying disciplined and informed. Automation amplifies both your strengths and weaknesses. If you approach it methodically, it will reward you with consistency and scale. Thank you for watching Finance Unpacked. If you found this video helpful, hit the like button, subscribe, and click the bell so you never miss an update. Drop a comment below. What kind of trading bot would you build? Until next time, trade smart and stay financially empowered.